My name is 𝗕𝗲H𝗲𝗳𝗶𝘁𝘀. I'm with a company called Asset Preservation. I started out as a residential realtor, then I moved into commercial. I started working with 1031 exchangers approximately 9-10 years ago, who are interested in mostly retail net lease, mostly commercial, or the Delaware Statutory Trust kind of avenue, which is an alternative investment opportunity. I had my securities licenses, and now I strictly focus on teaching 1031 exchange tax code, as well as accommodating the exchanges for our clients. So, quick disclaimer for us as well. So I'm not a tax attorney. I'm not a CPA. We always encourage you to make sure you talk to them about your tax needs. This is strictly for educational purposes, and I hope it's helpful for you. So asset preservation, we've been around for actually 35 years. I need to change my slide. We celebrated our 35th year this last year in March. We've performed well over 200,000 1031 exchanges on behalf of our clients. And we are also a member in good standing with the Federation of Exchange Accommodators. So this is very important because something most people don't realize is qualified intermediaries are an unregulated industry. So it's very important that your clients or you go with a qualified intermediary who has a long history and has a good amount of credibility, because there have been some bad actors in the past where people have invested funds and they're not there on the other end, or even absconded with people's money. So we've been around for 35 years. We've performed all these well over 200,000 on behalf of our clients. And we're also backed by a larger company, Stewart Title, which allows us an extra layer of protection as well as additional protection of your funds. So what we're going to be talking about today, again, are 1031 exchanges, which is tax deferral on the sale of a property used in a trade, business, or held for investment when exchanged for like-kind property. We're going to go over capital gains taxes. We're going to go over exchange entities and why those are important. Like-kind property, what is that? Holding period and identification rules. So when your clients have property, obviously they can hold the property and see what's going to happen in the market. If they're in a low growth area, it would be a good opportunity to start looking around for a more high growth area. They can choose to sell their property and pay their capital gains taxes, or they can decide to do a 1031 exchange where they have an opportunity to defer all capital gains taxes with a fully deferred exchange, or do a partial exchange and receive some boot. But it gives them the opportunity to redeploy that equity that would have been used to pay capital gains taxes so that they can purchase larger replacement properties. So let's see, what is the tax code? No gain or loss shall be recognized on the exchange of real property held for productive use in a trade or business or for investment, if such real property is exchanged solely for real property of like kind, which is to be held either for productive use in a trade, business, or for investment purposes. So remember, this is a tax code, and this is pretty much what the main gist of the tax code is. So capital gains taxes, this is what we're trying to avoid having to pay. There's 4 different layers of that. So first off, there's going to be a 25% depreciation recapture. Federal capital gains tax is 15 to 20%. 3.8 for net investment income. And California has the highest state tax, which is at 14.4%. So you can see that those layers together are going to add up to quite a bit. So we're going to give an example of that so you can kind of see what could happen if you decide to just pay your capital gains taxes. So there's a married couple filing jointly. They sell an investment property for $1 million with no debt. The couple originally purchased the property for $400,000. So this property has now been fully depreciated, okay? So that means that $400,000 has now reduced by $300,000, which gives them a new tax basis of $100,000, which means that now their capital gains taxes are $900,000. Or their capital gains are now $900,000. So we're going to look and see what that looks like if they were to pay those taxes. So you take your million, you then have your depreciation, which is $300,000. That's going to be taxed at 25%, $75,000. The remainder of that is going to be taxed with federal for 20% at $120,000. Then you've got your net investment income tax at 3.8. And then we're going to do 13.3 for the state tax. So you can see that's $651 left over. You've paid almost $350,000 to the government. With a 1031 exchange, you would have been able to redeploy those funds to maximize your new investment. So what does that look like? They're going to have $651,000 left over to purchase something, or they've got $1 million left over. So this is the cash that they've got, right? So if they decide to leverage up to say a 75% loan to value, the most you could do if you just sold it would be $2.6 million. If you use the 1031 exchange tax code, you can actually redeploy up to $4 million for investment. You can see how that's going to make a huge difference on your investment opportunities, because you're going to get more of a return on $4 million investment than you will on a $2.6 million investment. So what are some of the reasons people might want to do a 1031 exchange? So first off, leverage. You can take that low debt or no debt property, again, redeploy your funds and purchase maybe multiple properties or a larger property. Diversification. This could be by asset class or by geography. So maybe you want to get out of single family, you want to move into retail net lease properties, or geography. Maybe you're in a state that's not as friendly to landlords, you want to move that to another state, or maybe you're moving and you want the property to be closer to you, so you're going to move that as well, or you might want to move it into a more high growth area. Consolidation. Sometimes people have a lot of properties and they decide it's too much to manage, so they'd rather have one or two smaller assets, maybe like an apartment building with an office manager, or they want to, sell 3 single family residences and purchase like an auto zone or something like that, where they just have to do, low maintenance on it. Cash flow, that's kind of the main reason we have investment property. Yes, someone's got a question?
Yes, regarding like kind, how's that defined? Is that the value, or is it just commercial property for commercial property, or commercial versus residential? How's that defined?
So like-kind property is basically any real property held for productive use in a trade, business, or for investment. So you can go from raw land to industrial to single family. I will have a slide on that coming up, but that is a good question. Lots of people are confused about what like-kind means. So getting back to this, we've got cash flow. That's kind of the main reason that people go into investment real estate. Management relief, again, say maybe they've got multiple properties, they'd rather consolidate that into a smaller one. Increased depreciation and estate planning. Estate planning is a really important one for a lot of people, especially when they're, a little bit further in, they've been having these properties and they're going to be leaving them to their kids. Maybe they've got 2 or 3 large assets. Maybe they've got 5 heirs that they want to leave. So they're maybe going to figure out different ways of leaving something to each child or each heir. Exchange entities. Why are these important? Okay, so we need to remember that 1031 exchange is a tax code. So it's associated with the taxpayer. So if the wife is the one that's selling the property, then the wife is the one that's going to be acquiring the property. If an LLC is the taxpayer that's selling the property, then the LLC is the taxpayer that's purchasing the property. One thing we want to pay attention to with LLCs, especially, lots of times people might have an LLC that's there strictly for liability purposes, but actually the individual or the married couple is actually the taxpayer. So we want to pay attention to that. It's very important that we identify the correct exchange entity. Say there's a partnership that's selling, then the partnership needs to acquire. If there's an LLC or a partnership and they wish to go their own separate ways, that's not going to work, because with a partnership, It's the partnership that owns the property. It's not actually the individuals. So again, it's very important that you always check with your CPA or your tax advisor to make sure you understand who the tax entity is that's doing the exchange. How long do I need to hold property before I can exchange? So technically, there is no holding period. Conservatively speaking, it's going to be 24 months. So the IRS has created a private letter ruling indicating that if you hold your property for a minimum of 24 months, that basically satisfies their requirement that they look at for holding for long-term investment purposes. If you're going to do it less than a year or less than 24 months, then you want to try and have it at least so it covers 1, possibly 2 tax years. So you're always going to want to go back, check with your CPA. Again, what is the intent when you purchase the property? That's what they're going to go back and look at, because 1031 exchanges, when you purchase your property, what is your intent when you purchase that property? Like-kind property. That was a good question. So you see on here, pretty much everything here is allowable as like-kind property. Again, any property, any real property held for productive use in a trade, business, or for investment purposes counts as like-kind property. So what are some of the real properties that do not qualify for 1031 exchanges? So your principal residence does not qualify. Remember, 1031 exchange is investment property for investment property. So your principal residence does not qualify for that. Property that's held for flipping purposes. You purchase a property, you fix it up and you sell it. That also does not qualify for a 1031 exchange. That is viewed as by the IRS as inventory. So it doesn't count as investment property. So qualifying, any relinquished real property held for productive use in a trade, business, or for investment, exchanged for replacement property held for productive use in a trade, business, or for investment. And again, that can be broad. It can go from raw land to commercial, single family, multifamily, office, industrial. Also, there's something called a Delaware statutory trust, which is an alternative to actually having your own real property. It's a portfolio that's created by a sponsorship entity, which is a passive investment. Yes. Question?
Yes. Does that matter if it's active or passive income?
No, it does not matter if it's active or passive income. It could be, you might just have property that you're holding even for appreciation purposes if it's a piece of raw land. Active, so that would be really a passive investment where you're not really doing anything. It's just sitting there and appreciating, or with a Delaware statutory trust, that's also a passive investment where there's a sponsorship entity that's going to be managing the portfolio. So a DST is similar to a REIT, which is a real estate investment trust, but you're not allowed to 1031 directly into a real estate investment trust. You can stop over in a DST and then move on to a REIT. If anybody wants further information about a Delaware statutory trust, they're welcome to give me a call after this, and I'd be happy to talk to them about it. It's for
Stephanie.
Yes.
I was going to ask if you maybe at the end, if you can just kind of go over a little more on the DSTs, specifically some of the benefits to some of the senior owners. Like I work with a lot of senior owners that don't really want to 1031 actively back into real estate. So anyway, if that's something we have time, if we can earmark it, maybe you can talk a little bit about that later.
Yeah, I can definitely do that. Or, you know what, I'll just take a quick minute to do it right now. So a Delaware statutory trust, referred to as a DST, it's only called that because it was first done in Delaware. There's no other reason that it's referred to for the Delaware part. So basically there's a sponsorship entity. They're going to purchase a certain amount of investment properties. It could be made up of multifamily and senior housing. It could be investment grade retail net lease properties. Say there's 15 to 20 properties in a portfolio. The portfolio is worth about $120 million. Your client can sell their property and buy into the DST where they become a fractional owner of all of the properties that are in that portfolio. So that provides some diversification. It's also a completely passive investment. The sponsor entity that created the Delaware Statutory Trust is the one that's going to be managing it, collecting rents, taking care of the properties, making sure that everything's being taken care of in that portfolio. So the thing with the portfolios, though, there is a holding period. It's usually anywhere from 3 to 5 years or 5 to 7 years. At the end of that holding period, your client would have the opportunity to do one of 4 things. Different DSTs have different exit strategies. The 4 that are possible are using tax code 721 to go into a REIT. They can do a 1031 into another DST. They can do a 1031 into another property that they're going to own and manage. They can choose to cash out and pay some of those capital gains taxes, or do a combination of all 4 of those. So those are some exit strategies. So they're going to have to work with a registered representative because a DST is considered a security. I do have some that I've vetted. If you have people that you know who are securities representatives as well, that's very important. You want to get one that's been around for a while and kind of, they know that they do a good amount of due diligence. So each DST has something that's called a private placement memorandum, which is basically a brochure describing all the properties that are in the DST. So you want to make sure that your registered representative has a strong due diligence team that does a deep dive into all of the PPMs to make sure that they're going to be performing near what the sponsorship entity is indicating. A good one is basically going to review hundreds of them a year, and they're only going to recommend about 15% of them, maybe even only 10%, depending what's on the market. So those are good for multiple reasons. For estate planning, like you were saying, when you've got your older clients. So the good thing about that is 2 things. First off, it can be divided up by percentage and left to all of the heirs. So if you have certain people, you want 25% and 10% and 50%, however you want to divide that up, it's divisible easily that way. Also, if you might be worried that your heirs might be inclined to take their inheritance and spend it frivolously right off the bat, the heirs will be stuck in that DST for the remainder of the holding period. So say there's still a year and a half left on that holding period. The heirs are going to get used to getting that passive income where it comes every month. So they're going to be like, oh, this is great. This actually pays my rent. Or this is good. It's paying all these bills for me. So they're going to be less likely at the end of that holding period to just blow the money, and hopefully they'll reinvest it and continue getting a return on the investment that you created for them. So that's a little bit about DSTs. Sorry for the whole sidebar.
That's all right. Just one quick question for you on that. Just on the DST, I'm assuming they get paid like a % of interest over the course of those 3 or 7 years. Is that paid annually? Is that paid monthly, quarterly, or does it depend on the DST vehicle?
Typically, it's paid monthly. On occasion, it is paid quarterly, but I'd say the majority of them are monthly payments. And the cap rates right now on those are usually somewhere between, I believe at the moment they're trading around 4.5 to maybe 6.25, depending on the risk factor of the DST. It changes over time. Also, some of them are all cash investments and some of them carry debt. So if your client has debt, it's also good to know that the sponsorship entity is the one that carries the loan. They go out and they get that non-recourse loan with the bank. So if your client has a good amount of debt, they can buy into a DST that's already got debt built in, and they don't have to go out and get their own loan. So that's another benefit.
Okay, thank you. That cap rate you mentioned, is that the return yield they'll get?
Yeah, capitalization rate. So what they're going to get a return on their investment. So that's, like if it was retail net lease, they've pulled out all of the costs. So their net operating income divided by the amount of the investment that they make will basically determine what the cap rate is. And the sponsorship entities already create that setup for you.
Okay, and last question, I'll let you get going.
Okay.
Minimum contribution. Sorry, Jill. Is there a minimum contribution?
For most of them, it's 100,000.
Okay.
Some of them might go to 85. It's also, if you're doing a 1031 exchange and you're, say, selling a property for $900,000 and you purchase something for $700,000, you can take that leftover and put it into a DST. So it's good for multiple things. It's a good backup. It's a good way to pick up any little bit of leftover funds that you don't want to reinvest. And it's a good, instead of just being a backup, it's a good direct one where you're not having to worry about managing property anymore, and a good way to estate plan for your heirs.
Okay, that's good to know. Thank you for answering those questions. I appreciate
You're
it.
welcome. Of course.
No, that's great question, Stephen. I think I have a follow-up question on that, Stephanie. I know there's a lot of questions on DST. That's not the main focus here, but it looks like an alternative. If you can't find a good property or you're not able to close with the properties that you identified, then is DST considered more like a plan B, or what do you typically see?
So I see both, to be honest. A lot of, again, the older generation who are tired of management and are looking at basically estate planning, and they don't want to have any more real property, but they also don't want to pay those capital gains taxes. A DST is a good first choice for them. But there are people who are looking at properties and they're, getting near that 45th day and they're like, I'm not finding anything. I don't trust that I'm going to be able to complete my exchange, and I really don't want to pay those capital gains taxes. So I'm going to hop into this DST for 3 to 5 years. And then after that, I'll decide if I want to own my own property again, or if maybe I actually like this as a better investment. But it can be a backup. So say they identify 2 properties and then they have a third one as a DST, just to cover in case they are not able to close on the first 2 that they identified.
Thank you.
Of course. Okay, so exchange equation. So this is a little bit of information about what the exchange looks like for a fully deferred exchange. So 2 things are important. First off, you need to reinvest all the net proceeds, so all the cash that you get from that. Also, you need to acquire a property with the same or greater debt, meaning basically you need to replace that debt with new debt or with cash. So this is what that would look like for a fully deferred exchange. They are selling a property for $900,000. They have $300,000 of debt on that. The cost of the sale, which does not need to be reinvested, is $60,000. That's closing costs and commissions. And then the net equity they're going to get from that is going to be $540,000. So they're going to purchase a property for $1.2 million. While they're doing that, they're going to reinvest all the net proceeds. They're going to put in the whole $540,000, and they are going to increase their debt by up to $660,000 for that replacement property. So for this one, over to the right, you'll see that it says boot. So boot is basically any amount of either debt or cash that's not reinvested. Boot is subject to capital gains taxes. So you see here, there is no boot. So they've effectively done a fully deferred tax.
And if I heard you correctly on your previous example, if there was boot and if it was, say, 35,000 or higher, they could potentially roll that into a 1031 or a DST, right?
Well, if it's only 35,000 they've got left over, possibly not, because most of the minimum
Is
for a
100.
DST is going to be around $100,000.
Okay, thank you.
So here's what a partial exchange would look like. So they're selling their property for $900,000. Their debt, $300,000. Cost of sale is $60,000. They have $540,000. They're going to purchase the property for $700,000. So from the net equity proceeds, there's $100,000 of boot that they're not going to reinvest. And they're also not going to be increasing their debt above or to the same amount that it was before. It's going to be $40,000 less. So there's $40,000 of mortgage boot and $100,000 worth of cash boot. So you can see they've got $140,000 there of boot, which means that amount is going to be subject to capital gains taxes. So if your clients need to pull money out and they don't want to pay the capital gains, lots of clients, instead of choosing to hold that $100,000 prior, will decide that they're going to reinvest all the net proceeds and then refinance the new property at some point and pull cash out at that time. So either of those works. Just wanted to let people know, like, if they need cash, might make more sense for them to reinvest everything and then refinance the property and pull cash out of it later instead of paying those capital gains. So what does a 1031 exchange looks like? So you've got your taxpayer, they're going to sell their property. Okay. The buyer is going to put their funds in with escrow. Escrow is going to hold those funds. When escrow closes is when your identification period and your closing period start. This is when your time clock starts at close of escrow. So at close of escrow, the funds are going to be transferred to the qualified intermediary, where we're going to hold your funds in a segregated account, non-commingled account, until you're ready for either the earnest money deposit or the final cost. So I suggest people aggressively start looking for their replacement property the minute they go under contract. And the reason for that is the identification period is 45 days. 45 days is shorter than you think. It goes really fast. So it's important to really find your property, vet it as quickly as you can, get those inspections done, and get moving with that. So they've got 45 days from close of escrow to identify the replacement property and 180 days to close on it. So they're going to find their property. They're going to let us know. We can send over the earnest money deposit. Then when it's ready to close, those funds go to the seller of the replacement property, and then the property gets deeded back to the taxpayer. So what are the identification rules? So first off, it needs to be made in writing. It has to be unambiguously described. It has to be signed by the client. Hand-delivered, mailed, telecopied, or otherwise sent back to the qualified intermediary. We have to have it back by midnight of the 45th day. Whatever's on your list by midnight of the 45th day, those are the only properties you're able to close on. So you really do want to start looking for your property as soon as possible, getting the inspections done, and making sure that at least one of the properties on your identification is going to close and cover the costs that you need to cover for your tax deferral. What are the other rules? So there's different ways to identify. So first off, there's the 3 property rule. This is the one that's used the most. So the taxpayer may identify up to 3 properties of any value. This is important. So they can identify up to 3 properties of any value and close on 1, 2, or all 3 of them. If they wish to identify more than 3 properties, they can, but then there's going to be a limit on the value that they can identify. So this is called the 200% rule. So basically, they want to identify more than 3 properties. That's allowable, but there's going to be a limit on the amount they can identify. So say your client needs to identify $1 million. So the most they can identify with all of the properties combined would be 2 million. So 3 property rule, they can identify 3 properties of any value. 200% rule, they're going to put a cap on it. So here we've got the 95% rule is the final one. This one is not used as often because it's a little more strict. So they want to identify more than 3 properties and they want to be of any value. So they can do that. However, they better be sure that they're going to close on everything because they need to close on 95% of whatever they identified if they're going to use that rule. So if they were identifying 5 properties and one of them didn't close, most likely that property wasn't, worth $3,000. So if they haven't closed 95% of whatever they identify, they would blow their exchange.
Can you please explain this 95% rule again?
What was that?
Can you please explain this 95% of rule again?
Yeah, so they want to identify more than 3 properties and they want those properties to be of any value. That's fine, they can do that, but they need to close on 95% of whatever they identified.
Okay, thank you.
So basically, they have to close on everything they identified, generally speaking, or that's not going to work out for them. Okay, can they sell multiple properties and buy one? Yes, you can. The only thing you want to pay attention to, though, is your time period starts at close of escrow of the first property. So you might want to have 1 or 2 options to extend that closing date to allow all 3 properties to sell and to allow you as much time as you can for your identification period as well as your close period. So you can sell multiple properties, but your time clock starts at close of escrow on the first sale. So again, putting in some options to extend on those properties might be a smart move. Can you sell 1 property and buy multiple? Yes, you can, but you've got to identify when close of escrow on that sale, you have to be able to identify the multiple properties within that time period and close on all 3 of them. This one as an example, all 3 of them within that 180 days. So it can do multiple sales or multiple purchases. Again, the time period still exists and is still just as strict as it normally is. Oh, that was interesting. What should your clients do prior to the exchange? Always have your clients consult their tax advisors. There have been multiple times I've had people coming to me wanting to do exchanges, and after talking with them a little bit, I realized that there is no need for them to do an exchange. Recently I had a woman who inherited property from her mother. Her mother had had it as a rental for years. The daughter's name, but the daughter was never a taxpayer. So she never was considered a taxpayer. So when she inherited the property a year prior, the appreciation of the property, there was none. It was pretty much worth what it was when she purchased it. So she would have wasted her time and money and put herself through stress of following all these rules when there was really no need for her to do an exchange. Once I spoke with her a little more, I was like, can you go back with your CPA and check and see if you were a taxpayer, or if it was only your mother? And so we found out she didn't need to do the exchange, saved her some stress. She didn't have to go through the whole process. She was able to just sell her property and purchase whatever she wanted to on the other end. Consult a qualified intermediary, so give me a call when you're ready to do that exchange. Again, confirm who the taxpayer is on that property. And we're going to confirm that the purchase agreement and the tax ownership are actually in sync. So here's my contact information. If anybody has any additional questions, I'd be happy to answer those.
Hey, Stephanie, good morning. Me again.
Hi.
So that scenario you were just talking about, daughter never on title. So that sale, those proceeds will not hit her from a 1031, hit her tax perspective at all, because it's going to.
She didn't, there was no appreciation on the property. So when the mother passed, and left the property to her daughter, that property got a step up in basis. So any capital gains that the mother had incurred, the mother had deferred because she was doing 1031 exchanges. But the daughter was never a taxpayer. So when the daughter inherited the property, she got that step up in basis. So a year later, after inheriting it, the property hadn't appreciated at all. It was worth exactly what it was when she inherited it. So that's another important thing. Sometimes people try to do estate planning, or they want to put the kids on title early to make sure they get it. And then the kids start paying taxes along with that. Then the kids actually inherit those capital gains taxes. So it's always important when you have investment property to make sure that you're consulting a tax advisor on how you should set up your estate, so that you don't make a mistake, put your kids on, have them start becoming taxpayers, because then they would inherit those capital gains that you had already incurred. So the mother was on title, but she had never paid. They just put her on title. Or, I mean, the daughter was on title, but she'd never paid any taxes. So according to she wasn't a taxpayer entity.
So I have a question. So you're saying that the child is in the trust, but not on the deed of the property. And when that parent passes away, because it's set up that they're not on the deed, but they're in the trust, that the amount resets and they do not have to pay capital gains on that then when they sell?
As long as everything's set up correctly, that's how it's supposed to roll, yes.
And that's set up through a trust?
Usually through a trust, but normally most property that's inherited by the children or by the heirs gets that step up in basis.
Right.
It's referred to as swap till you drop. So, because when we're doing a 1031 exchange, those taxes are getting deferred. They don't disappear.
Right.
But if you hold them and continue doing 1031s until your heirs inherit them, then you have effectively completely deferred and gotten rid of those capital gains taxes.
Yeah, excuse me. You mentioned something about had the daughter make the do the income tax return, it would have been different. What would be the difference?
Well, because then the daughter would have been a taxpayer entity, and then there would have most likely been capital gains that she would have incurred as a taxpayer on the property.
The step-up basis would not apply to her then?
Right, because she would already be partial owner of it.
Okay.
So
And-
she might inherit it, but she was already partial owner of it. So she might get a half step up in basis. It depends on how they've set everything up and how the CPA has been reporting things. So again, it's always important for your clients. Again, I'm not a tax attorney. I can't give actual tax advice. I can just talk to you about the rules of the exchange and how things are supposed to work and how they might work. But you always want to consult a tax advisor and your CPA when you're working on setting up your estate for heirs to inherit.
So you're saying that even, okay, so if she's on the deed, or if they're on the deed and they're not paying taxes on it, then, and they're in the trust, they shouldn't have to pay taxes.
Vesting doesn't, unfortunately, sometimes there are mistakes with vesting. So title gets recorded incorrectly on occasion. Like they have the daughter on title, but the daughter was never a taxpayer. The CPA never set anything up where she actually had any burdens or benefits from the property. She didn't pay insurance. She didn't pay taxes. She didn't have any real ownership of it. Her name was just on the paper, but
Okay,
it didn't. So they had vested it wrong. They had done title incorrectly. But the daughter, as far as the tax, as far as the IRS was concerned, the daughter was never a taxpayer on that property.
even though her name was on the deed.
Yep.
Okay,
It was just vested incorrectly. The CPA was able to confirm she never paid taxes on it. The IRS does not see her as a taxpayer. Title was done that way. People do it and they shouldn't. It's always best to, again, consult your CPA, consult a tax advisor when you're setting up your estate, when you're doing vesting, talk to title about it. Because that can happen. And she thought she was on title, so she thought that, she was going to have those gains. But when she spoke with her CPA, they realized that no, she's not a taxpayer entity. And never
Okay.
had been.
okay, thank you.
Yeah. Back to the DST. If we hire you to do the exchange, you pick the DST company for us?
No. So what I would do if you're going to use me to do the exchange and you're interested in doing a Delaware statutory trust, I have about 4 or 5 registered representatives, so securities representatives that do nothing but review DSTs. So I would give you their contact information. I'm not affiliated with them in any way, shape, or form. I used to be a sourcing broker for a DST, meaning I used to purchase properties for DSTs. I used to talk to clients about either going into a DST or purchasing their own retail net lease property. So I vetted some registered representatives so that I could provide my clients with good contact information when they're going to be looking for a DST. So again, they've all got really strong due diligence teams that do a deep dive into the private placement memorandums. They review hundreds of them a year, and they usually only recommend about 10 to 15%.
So how
I
do
would
we
give you
know
some
which one
contact.
how do we know which DST is good? Because there'll be a lot of money exchanged through the 1031. How do we know they are good? And also, if we pick one DST, later on we found the property, can we take the money out of the DST to invest in a regular brick and mortar building?
So again, I would give you a list of securities representatives who have strong due diligence teams that review all of the DSTs on the market. So you would call them, let them know what your needs and desires are for your investment purposes. They would let you know which ones are on the market that they would recommend, and they would help you navigate which ones are going to work best for your situation. They might even put you in 2 or 3 of them for diversification purposes, depending on what your needs and wants are. Secondly, so again, they do have holding periods, and I mentioned they're usually either 3 to 5 years or 5 to 7 years. So once you go into that DST, you're pretty much stuck in that DST for that holding period. At the end of the holding period, they're going to close up that DST. At that point, there are possible options that are allowed in the DSTs with the exit strategies. Different sponsors have different ones that they allow. The 4 possibilities are: you can use tax code 721. to roll into a real estate investment trust, where then you become an owner of operational shares in that REIT. You can go into another DST using tax code 1031 exchange again, or you can 1031 exchange into real property again. So you can go back to real property if that's what you want to do, or cash out and pay those capital gains taxes, or do a combination of all four of those things. So those are the exit strategies that are allowable. Different ones might push you certain ways and won't do all of the options. So again, you want to talk to the registered representative that reviews the DSTs, make sure they understand what your needs and wants are and what your options are for exiting.
And you can leave it in there. You can leave it in there for indefinite time too, right?
No, they close it up either 3 to 5 years or 5 to 7 years. When they close up that DST, you can 1031 into a new DST if you want.
Oh, okay. All right. Thank you.
No, I think these are awesome questions, Tiny. Anybody else have any questions for Stephanie? Raise your hand or just unmute
Yes, I have
yourself
a
and you can
question.
ask. Oh, by the way, Stephanie,
I have a question.
quick reminder, if you haven't registered for the giveaway, the link is in the chat. Terrell or Nisha, if you can put the link in the chat. Please make sure that you register your name. If you've already done it, you don't have to do it again. No cheating. So you can put your name in there one time, and if you're not done it, do it again. Do it now, because we are going to take that list to do the drawing after the Q&A is done. All right. If anybody has any questions, go ahead and ask Stephanie.
Hi, this is Kay.
Hi, Kay.
Hi, I'm here in California also, by the way. Great presentation. Quick question. So, let's say if I'm raising fund, okay, and the investor, okay, allocate the fund as a 1031 exchange, and I cannot close. Let's say they lock the fund already, and I cannot close. What will be consequence to the investor that do 1031 exchange with me to invest in my deal?
I'm a little bit confused. You're raising funds? What?
Yes. Let's say I'm raising fund for multi-family deal, and then the investor, they will invest to my deal through 1031 exchange, and we lock the deal, go through due diligence, and the deal cannot close, falling apart. Let's say, for example, and it cannot close on time, 180 days. What will be penalty passed through to the investor because we cannot close the deal and they lock the fund with us? As a 1031 exchange.
Yeah, so if they don't identify within the 45 days, they blow
Yeah.
their exchange. If they don't close within the 188 days, they blow their exchange, which means all those funds that were not reinvested or any debt that was not replaced would be subject to capital gains taxes.
Okay. Even though it's our
It does not matter.
doesn't
Yep.
matter. Okay.
Yeah, like if they're buying new construction, they want to make sure that that property is going to be at least developed to the amount that they're investing into it by the time that 180 days comes around.
So Stephanie, can you talk about, I think just a follow-up on Kay's question is, can you even exchange into a syndication? Like, it looks like she's doing a syndication.
Yeah.
So yeah, I was going to talk about that too. So if they are a single individual going into your fund, they would be purchasing as a tenants in common. They couldn't just buy into a partnership. They would have to go into that as a tenants in common. So once there's a syndication, it's a partnership. So the syndication then owns the property. The individuals don't own the property. So the taxpayer, if they were going to buy into a larger investment, there could be a couple tenants in common that are purchasing the property where they each have an undivided interest in the property. Say 5 people are going to purchase something together and each one of them is going to have 20% of that property. Each one of them is going to hold the benefits and burdens of that property as their own individual ownership. But they cannot purchase into a partnership because then they're no longer the taxpayer. The partnership then becomes the taxpayer.
Okay, so a follow-up to that. So let's say they are LP, limited partner, silent partner, as invested to us. they're still responsible as a penalty. We are the GP and into the deal.
I'm sorry.
I mean,
missed-
when we structure LLC, we have GP and LP. They came in as a LP limited partner to invest in our deal.
Mhm.
And their fund came through as a 1031 exchange. So my question is still falling to, if in the case that we cannot close the deal on time, do we will be the one who responsible to pay for the tax, or limited LP investor?
I think the LP investor should be responsible. Why should your syndication be responsible? Because they're responsible for their funds, right?
Yeah, the client that's doing the exchange is the one that is responsible for paying those capital gains taxes.
Stephanie, yeah, regarding the same question that I have, can, as an LP, invest into the funds that GP controls, general partner controls? Because what I've heard, you have to invest as a company who has parked the money as 1031 exchange. That company has to reinvest the money into the fund, into the real estate. Isn't that true?
So a partnership can do an exchange. Syndication, a partnership can do an exchange, but the whole partnership has to do the exchange. If it's an individual, they have to own the real property. So a partnership is the one that owns the property. If you're in that partnership, you own operating shares of the partnership, but the partnership is the property owner. So the partnership, it would be the one that has to do the exchange. The individual is doing an exchange. They need to buy into it as an individual, where they're still going to be the taxpayer.
Yes, that's what I thought. Because what I've heard, and maybe I'm wrong, that the LP, if there's a limited partners coming in to as an 1031 exchange and buying into that property that all the LPs are investing in, it's a different entity.
Right. So it's not the taxpayer entity anymore.
Exactly.
Right. So it would not qualify for the exchange.
Yes, that's what.
Unless you go into it as a tenants in common. The
Yes.
whole partnership can do the exchange, but the individuals can't. Now, if you have a partnership, say there's 3 people in a partnership, and they know that eventually they want to go their own separate ways, they can drop out of the partnership and then go their separate ways, but you're going to want to season that a little bit. So they would want to get together with either a CPA or a tax advisor on how to go about dissolving that partnership so that they each become their own tenant with an undivided interest in the property, and then they can go their own separate ways later. But they'll want to do that as far out from putting the property on the market as possible. Especially if you have property in California, they're much more strict about a drop-in swap than they are in other states.
All right. Hey, Stephanie, one lab before I hop off, can you send us this presentation? The slides that you had. May have missed some things and may have a question later on.
Yeah, if anybody wants a slide, feel free to send me an email and just ask for the slide presentation from today, and I will send that over to you in PDF form.
Appreciate that.
Mhm.
So is this also going to be a link for this video again to watch it?
Yes, Brenda, we will upload the video on our ROI Muse portal and then you can watch it from there.
Okay.
Also
good.
on our YouTube channel, yeah.
How do
Okay.
we get those videos again?
We will send out a link for that. If you are a member, it will be, you can, when you log into ROI Muse, you can see it under the video portal.
I don't know if I just registered yesterday to
We will send you some information, Jack. Don't worry. Just send an email to support roimews.com, and we'll take care of you.
All right. Thank you so much.
I have a question regarding secondary properties.
Before that,
So
Donovan,
if-
let me ask Stephanie if she
Yeah.
has time, because we only asked her to stay till 11 or 11 Central. Stephanie, can you take a couple more questions? Or
I can take a couple more questions.
Okay, go ahead, Donovan. We want to be respectful of her time. Go ahead, Donovan.
If I'm flipping a property, but I'm holding it for rental purposes, as long as I hold that property for 24 months with a renter in it, I can do a 1031 exchange after that 24 months. Is that correct?
Conservatively speaking, 24 months would be the best amount of holding period from ownership to sale. Again, there is technically no holding period. Private letter ruling indicating that 24 months qualifies basically the IRS's to the IRS's satisfaction that that's been held for productive use in a long-term investment purpose. Technically, there's no holding period. So an example of that would be, I had a client recently purchased raw land. He was going to build some cottages on it. He purchased it for $350,000. He was talking with realtors and planning and zoning and construction and getting everything together. 8 months later, somebody came and offered him $850,000 for that property. And so he decided to sell it. He paid taxes on it while he owned it during that time. So he didn't cover one tax period, which was good. And he went back to his CPA and was like, can I do this? Can I do an exchange? And the CPA said, yes, we have a paper trail that indicates what your intent was when you purchased the property. It shows that you purchased the property with the intent to hold it for long-term investment purposes. So it can be less than 2 years if there's reason to sell it less than 2 years. But conservatively speaking, the safest bet would be to hold that property for 24 months. And yes, you can fix it up, buy it, fix it up, put a renter in there for 24 months and then sell it, and you should be good to go.